Hello and welcome to Views from the Market, Midmarket Private Equity and M&A in Canada. My name is Mario Nigro, and I'm a partner in the Private Equity and M&A group at Stikeman, Elliott. For today's podcast, I'd like to welcome our special guests, Robert Bezede and Thomas Bevilacqua. Robert and Thomas are the co-founders and partners of Harmony Succession Partners. Robert, Thomas, thank you for joining us and welcome.
Appreciate it, Mario. Thank you for having us. And one day when Robert makes his lower middle market Hall of Fame, you're a first ballot Hall of Famer.
I look forward to it, Mario. Your acceptance speech is going to be amazing to watch.
Thank you, guys. That's great stuff. Thank you so much. I'd like to start by talking a little bit about each of you, your own histories, and then talk a bit about Harmony Succession Partners. Maybe I'll start with Robert first, a little bit about yourself, and then Thomas, and then we'll talk about Harmony.
Sure. Yeah. So I started my career in the commercial banking space, financing M&A transactions. And that was really the first time I came across this whole lower middle market M&A sector. One of my clients ultimately wanted to sell, and that became my very first client. So 6.5 years ago, transitioned full-time into sell-side M&A. Did a couple years with an accounting firm, and then early last year decided to join forces with one of the top players in the space, Thomas, my partner, and we decided to open up the Harmony Succession Partners.
Yeah, and then myself, born and raised in Toronto, I began my professional career at CIBC, Deloitte, and M&P, and ultimately just always wanted to do something more entrepreneurial. So in 2018, I moved into advising owners on the sale of privately held businesses and really haven't looked back. As Robert mentioned, January 2025, he and I co-founded HSP to really build a high-touch, lower middle market firm that's just focused on giving senior level support throughout the transaction process to privately held business owners. Since founding it, we've closed several transactions and have built a strong team around the platform. And yeah, interestingly, as Robert mentioned, one day we were closest competitors. And then as the story goes, we figured we'd be better partners than rivals. So I got down on one knee, and now kind of the rest is history.
Thomas, Robert, you've both been in the kind of lower middle market for many, many years. You clearly took a chance here in terms of creating Harmony. You believe in this space. What is it you're seeing? Why this space? Why now? I mean, there's a lot of people doing what you're doing. What's the unique element about this space for you that you believe you can have an impact on?
Yeah, it's a good question, Mario. For us, one of the key things that we see is that there's a lot of the other firms in the marketplace that view this area of the marketplace, that $3 to $30 million in enterprise value, as more of a layover to their final destination rather than really their destination. For us, that is our focus. We don't really want to go up market. We see the gap persistently being in that 3 to 30 million. And in particular, I would say that 5 to 20 million NEV. I'd say 80% of our mandates fall in that 5 to 20. And again, like as Thomas had mentioned, for us, we are dedicated 100% on the sell side, high touch, senior advisory support. All of us come from that Bay Street background. So we're bringing that middle market to the lower middle market and really trying to build a place where younger professionals can have a career. We have a lot of runway ahead of us, 20 plus years. And this is not really an end of a career journey. This is really a start of a career to build something long-term.
Yeah, just to add to that, we work with the founders, the second, third generation business owners of these privately held businesses. And I think one thing that's common is that a lot of our clients are first and only time sellers, Mario. And with that, it's a different dynamic because on the buy side, you've got people that have bought and sold 10, maybe even 20 businesses in some cases. So it's a little bit tilted when you look at that playing field. So for us, it's really just knowing that there's a huge demographic shift, which many people are aware of, the silver tsunami, as they say. So the number of businesses in this segment of the market, even in our backyard in Ontario, is, tremendous, right? So for us, we know that there's a lot of value to be added to those business owners who've just never gone through the process. There's a lot of unknowns, but certainly, having the right representation, just feeling heard through the process and educated and understanding what they're up against is really what we're focusing on. What's interesting working with a lot of these privately held businesses is that I think our goal is really to achieve a combination of value, deal terms, and long-term fit for the owner. And especially with how much people love their business, that fit element is critical. So we spend a lot of time, although we're representing sellers, being in the market and understanding who the buyers are and what they're looking for, so that once we have that right client, we can kind of marry those two parties together and make sure that our clients are working with the right fit on the other side.
You've been in the middle market for a long period of time. You've seen the space. One of the things that I love about seeing you both, take this to the next level in terms of creating harmony is the sophistication of the lower middle market and how we've really come a long way. And you, to me, you're a demonstration of that. Tell us a bit about what you're seeing in the market and the kind of what you bring to the market in terms of the value add. I mean, I think people sometimes underestimate the lower middle market in terms of the opportunities, the kind of businesses that are being sold, who's playing. I mean, if you could tell us what you're seeing out there and what you are trying to respond to by creating harmony.
Yeah, well, one of the reasons why we even named the business Harmony is, our intention is to work in harmony with all parties around the table. So one of the philosophies that both Thomas and I have is every transaction, there's three legs to the stool. There's the buyer, there's the seller, and there's the bank. And all three of those parties have to be aligned for that transaction to get across the line. Especially in this area of the marketplace, the common challenges are the financials, the accounting systems are not really strong enough and they're not detailed enough. There's friction, buyer-seller friction that often comes up in terms of the story and getting it across in a realistic and justifiable way. And so a lot of our diligence, really the key differentiator for us is we sink a lot of time on the front end to really flesh out and think like a commercial bank would in terms of underwriting the transaction so that when that buyer chooses to work with us and then take that opportunity to investors or to lenders, that's a bankable, financeable deal that actually gets across the line. So that's one of our first areas where, we're not looking to sign up clients and, throw it at a wall and see what sticks. It's a lot more intentional in terms of working with the right companies that can actually get to the finish line and that all parties feel that they're working in harmony throughout the process.
Well, when you see the middle market today, what are the challenges you're discovering in your practice now? This is kind of all on you now. You both wearing these deals. You got to make it happen. I mean, you're out there every day. You're on the front lines. What would you say are the characteristics, the challenges, and the success stories? Like, where are the opportunities? Where are the challenges for you?
Yeah, it's a great question, Mario. So, I think the biggest trend, and you probably see this time and time again, is just business owners are not properly prepared to sell their business. And yet you've got succession-driven deal flow that continues to hit the market, right? It's a personal reason why a business owner is looking to move forward and sell their business. But the financial statements, maybe the owner involvement or the tax planning just isn't where it should be at an optimal point to sell the business. And I think that is one of the biggest challenges that we face in our day-to-day is just making sure that we're being selective on what clients we're taking out and that they're actually ready to be sold. For us, it's how do we fix that? It's really just a product of educating more business owners. So one thing that we're trying to do is just get out and just be more vocal about this at different events and networking with different professional advisors to just have that conversation with their client a few years ahead of time so that they can really prepare for a successful sale. The buyer demand continues to outweigh the supply of quality sellers, at least. So I think that's something that's also an interesting dynamic within this marketplace where, there's a lot of players in the space. And we're even seeing bigger private equity firms dip down, especially for these smaller acquisitions for add-ons in today's market. And largely, I'd say the sentiment amongst private equity groups is that they're probably underdeployed a little bit because of that scarcity of deal flow. The other one I would say is there's a widening valuation gap on what's truly a high quality opportunity versus an average business. So we're seeing more creative deal structures on those maybe B or C opportunities as a result of that. And I think that on the client side just requires more honest feedback and client education. So I think a practical takeaway is just a quality business can still command a premium outcome, but buyers are more selective and kind of rewarding that preparation that a business can have before they take the company out to market.
You had mentioned, Thomas, we're seeing a lot more buyers. I'm noticing it too. The marketplace has gone broader for the lower middle market. Tell us a little bit about what you're seeing in terms of the buy side. Who are the players out there that you're seeing who are active, who are engaged in the space? And what do you think is driving the increase of buyers in the lower middle market? Maybe part of it, the answer is there were so few before that it's a lot more now, but get a sense from you of what you're seeing on the buy side in terms of who's at the table.
You've got a great vantage point of this as well, Mario, but we're seeing a pretty wide range. Like I would say the search funds, the independent sponsors, high net worth individuals, those buyer categories all seem to make up quite a large group of folks that we see on deals of our size, at least. Again, these are acquisitions that can, be taken down by individuals or by a group of investors. Even larger private equity groups, we're seeing more and more of them dip their toe in the little middle market here, as well as strategic companies. I think as the economy does what it's currently doing, a lot of companies are looking for different ways to grow. And one of that is, inorganic growth through acquisition. So we're seeing strategic players come and look for these opportunities. I think the simplest answer to your question, Mario, is just buyers in general view the lower middle market as a legitimate asset class. And I think there's been some early adopters that have picked up on this many years ago, but now there's more and more knowledge and I guess understanding of that amongst the buyer community.
Rob, if I can ask you to tell us a little bit about some of the dynamics of getting a deal done, in the lower middle market. In the middle market and the upper middle market, it's been harder to get deals done, right? We've had these macro forces. People are affected by uncertainty. Due diligence is taking longer. Buyers are asking more questions. And what are you seeing on the ground in the lower middle market in terms of ability to get deals done, in terms of forces that are affecting these deals?
Yeah, I think the one thing that we're keeping our eyes very closely on is the commercial financing marketplace right now for these transactions. A couple of years ago, when the search fund market became very popular in Canada, there was a lot of banks that jumped in headfirst underwriting these transactions. And in the last 12, 18 months, you're seeing some of that portfolio turnover, and some of these are not going as well. So there's this internal learning that the banks are going through right now to really distinguish what is a high quality search fund deal versus what is a higher risk search fund deal that's going to unfortunately require some sort of personal guarantee. And that's probably going to ultimately block that transaction from getting across the line. That's really the one thing that we're seeing. It's a very live and evolving thing. Certain banks have pulled back versus others remain more aggressive when it comes to lending to this area of the marketplace. I'd say that's probably one of the hardest areas. You have your traditional quality of earnings and due diligence requirements that it's been prolonged for. The traditional 90-day close has not been a 90-day close for 2-3 years now. And I think that's more common now and it commonly accepted. But really the financing angle is really where we see there being a little bit of risk and uncertainty that people are going to need to navigate in the next 12 months.
When you hit on something, and maybe I'll ask Thomas, the one thing I notice in the lower middle market is that we've had a greater success of getting deals done in this marketplace. And that could be some of the factors that we've talked about. There's a lot of buyers, less macro environment. But one of the other things I think that's really driving it is, and tell me if you think otherwise, Thomas and Rob, is it seems as though with the succession tsunami that we've been waiting for, now we have it, that sellers are becoming more reasonable on value expectations, that there seems to be a growing understanding, and at least in the lower middle market. I'm not sure it's in other places in the market, but there seems to be a kind of growing appreciation from sellers that, what they want to sell and they're willing to take a little less, or to, the valuation gap in the lower middle market is less. But let me know what you think. I want to get your perspective on that valuation gap in the lower middle market.
Yeah, it's interesting. If you're a privately held business owner, you've been through 20, 30 years, long history, obviously, but even in the past 4 or 5 years, they've been through a lot, right? So there's, I think, some recency bias to what business owners have been put through. And I think they also are looking forward and not feeling the most certain themselves about what the future truly holds. So I do wonder if that's playing some effect on their leniency or their willingness to accept a different lower valuation than they would previously, or maybe a more flexible deal structure, right? I think there's probably just an element of fatigue that business owners have, and they themselves, if they're not fully confident in the future performance of the business, I think that will naturally shape their expectations to be a bit more willing to work with buyers if, even if it's not hitting that country club multiple that they kind of hoped for.
And just to build on that, the reality is, from a number of conversations perspective, it's unbelievable the amount of business owners that are open and engaging in this whole pre-sale planning and the desire to sell at this time. Again, I think as Thomas had mentioned, the next 12 months, there's a lot of uncertainty. And so business owners are more and more doing their diligence around, well, what can I get for my business? Is now the right time? So we're having more conversations. But the gap in the marketplace is always going to be, is that business ready for sale today? Is it fundamentally prepared? And unfortunately, a lot of business owners have procrastinated when it comes to getting their business ready for sale. So just the sheer number of businesses that are ready is still limited. So even though there's a lot of interest to sell, I think the volume of the number of people that are actually going to get across the line in the next 12 months is going to remain limited.
So I always ask kind of a crystal ball question, where do you think the market's going? I'm going to ask you that, but I'm going to layer something on top of it. Obviously, in the lower middle market, we've seen more structure on deals. 100% cash has been less common. But what I've noticed in the last couple of years, and frankly, in the last 12 months particularly, is more use of the earnout. We've always had kind of promissory notes, maybe the rollover, but the earnout seems to become, and some of it is some of that bridging the gap on value. I wanted to see what you're seeing, generally speaking, in terms of trends, in terms of crystal ball where you think the market's going, but also in terms of the earnouts and just structuring in terms of deals. Have you seen some of these other instruments to kind of bridge the gap between valuation become more prominent?
So I think generally market sentiment remains pretty cautious. Again, we don't have the, Mario's crystal ball to perfectly predict this, but I think companies are facing softer demand. There's higher input costs and again, more uncertainty globally. Look at kind of the insolvency numbers and, in fact, some of the insolvency folks that we deal with are probably amongst the busiest on Bay Street right now. I don't know. I think it's a hard question to answer. I think the direction of the market, we're feeling a little bit uncertain about. But as they kind of say, bears sound smart and bulls make money. So I still do believe that there's certainly opportunities for people to do well in this environment. And I think a lot of buyers are probably looking at it from that perspective. Touching on the earnouts specifically, to be honest, it's something that we've always seen as well, right? I think it's the earnout for how I've seen it is it really is dependent on what are the outcomes that the owner is looking for, where an earnout may be more applicable than an equity role, depending on kind of the age and stage that business owner is at. But certainly, I think we're seeing more and more of that within the uncertainty that does lie ahead.
And Mario, just to add, our views, this is definitely a market of the haves and the have-nots. So if the business is really strong and, it would rank as an A-level opportunity and checks all the boxes, truthfully, the probability of an earnout is very unlikely because the competitiveness of that transaction is going to be incredible. And we're seeing that the strongest companies are getting more offers than they did last year or 2 years ago because there's just so many fewer of them out there and so many buyers looking for good opportunities. Now, on the flip side, the unfortunate performers in the marketplace that are looking to transact at this time, those are the companies that may have to accept earnouts. And yes, we are seeing those earnouts on those transactions.
Rob, Thomas, I want to thank you for joining us. It's been great to hear about your stories. It's super exciting to see, you obviously go all in on the lower middle market. And I hope Harmony Succession Partners becomes a success because it means more work. I want you to find buyers, both from a buy side and a sell side perspective. So thank you for tell us a little bit about what you're doing. And then also thank you for your perspective on the market. And it's greatly appreciated.
Well, we look forward to working with you, and I think we already got 2 with you, so hopefully there's even more transactions in the future. We really appreciate you laying the groundwork for really this area of the marketplace and allowing us to build this business. It's those leaders like you that have created this marketplace, and that's why we're here today. So thank you for all your hard work and your leadership as well, Mario.
Thank you for tuning in to Views from the Market. Stay updated with the latest episodes by subscribing wherever you find your podcasts or visiting stikeman.com/viewsfromthemarket.